For decades, the most important moment in any earnings season was the release of the numbers: revenue, profit, margins, beat or miss. Markets reacted instantly to what had already happened. But in 2026, something subtle yet powerful has shifted. Corporate earnings guidance often matters more than the results themselves. A company can beat expectations and still see its stock fall. Another can deliver average numbers but rally sharply. The difference increasingly comes down to what leadership says about the future, not what they report about the past. The new reason corporate earnings guidance matters more than results is simple: visibility is low and confidence is fragile. In a stable economic environment, past performance was a relatively strong indicator of near-term future performance. If demand trends were steady and financing conditions predictable, investors could extrapolate from results with some confidence. That's no longer the case. Today's business environment is shaped by rapid shifts in consumer sentiment, changing interest rate expectations, geopolitical uncertainty, supply chain adjustments, and accelerating technological disruption, especially from artificial intelligence. Because conditions can change quickly, last quarter's numbers tell you less about next quarter than they used to. Investors know this. So instead of focusing solely on what just happened, markets are placing heavier weight on management's forward-looking signals. Guidance has become a proxy for visibility. It reflects how confident executives are in order books, customer pipelines, pricing power, and cost control. In other words, guidance reveals what companies are seeing beneath the surface. Demand volatility plays a major role in this dynamic. Consumer behavior can shift quickly in response to inflation concerns or job market sentiment. Enterprise customers are extending deal cycles and scrutinizing budgets more closely. Even profitable businesses are cautious with spending. As a result, revenue pipelines can look solid one quarter and soft the next. Management teams are closer to these real-time changes than outside investors. When executives lower guidance, it often signals that underlying demand is softening before it becomes obvious in reported results. When they raise guidance, it suggests strengthening momentum. This makes forward-looking commentary incredibly powerful. Interest rates and capital costs amplify the importance of guidance. In a higher-rate environment, financing is more expensive and margin pressure is more visible. Companies carrying debt face tighter financial conditions if revenue slows. Investors want reassurance that earnings are sustainable, not just temporarily strong. Conservative guidance signals discipline and realism. Overly optimistic projections that later require revision damage credibility quickly. Markets are now more sensitive to credibility risk than to small earnings beats. There's also a structural change in how companies operate. Many businesses have shifted toward subscription models and recurring revenue streams. These models create greater predictability, but only if retention remains strong and churn stays low. Guidance provides insight into renewal rates, customer behavior, and forward bookings. A modest earnings beat combined with cautious forward commentary can raise concerns about future subscription stability. Artificial intelligence investment adds another layer. Companies across industries are investing heavily in AI infrastructure, automation tools, and data systems. These investments can weigh on short-term margins. If management communicates clear long-term return expectations and disciplined spending, markets may tolerate near-term pressure. But vague or overly ambitious AI narratives without measurable guidance create uncertainty. In 2026, uncertainty is what markets punish most. Another factor driving the shift is the speed of information. Financial markets process news instantly. Algorithmic trading and institutional positioning amplify reactions. When guidance changes, capital reallocates quickly. Because volatility has increased, investors seek early signals of turning points. Earnings guidance acts as an early warning system. Even modest downward revisions can trigger sharp stock movements because they suggest broader demand weakness that could ripple across industries. Corporate behavior reflects this reality. Executives are more cautious about issuing aggressive projections. Many prefer to guide conservatively and outperform rather than risk overpromising. Meeting or slightly exceeding stable guidance builds trust. Missing forward expectations, even after strong results, erodes it. Another reason guidance carries more weight is margin sensitivity. With cost structures under pressure from wages, energy, insurance, and financing, even small revenue shifts can disproportionately affect profits. Guidance reveals whether management believes margins will expand, stabilize, or compress. That outlook shapes valuation models more than historical performance. Investor psychology plays a role as well. In uncertain environments, markets crave clarity. When visibility is limited, forward commentary becomes a stabilizing force or a destabilizing one. If leadership expresses confidence backed by data, it reassures shareholders. If tone shifts cautious, even subtly, investors take notice. Tone, language, and phrasing on earnings calls now carry measurable market impact. Importantly, this shift does not mean results are irrelevant. Strong performance still matters, but results are backward-looking. Guidance bridges the gap between past and future. In a world where conditions can change within weeks, that bridge is critical. Companies understand that how they frame expectations shapes perception. Transparent communication about risks, demand patterns, and cost pressures builds credibility. The new reason corporate earnings guidance matters more than results is rooted in volatility and limited visibility. Investors are less confident that yesterday's strength guarantees tomorrow's stability, so they look to management for insight. Guidance reveals order trends, pricing power, cost control, and competitive positioning. It signals how prepared companies are for shifting conditions. In 2026, markets are forward-looking not just in theory but in urgency. The future feels less certain, so every hint about what lies ahead carries greater weight. That's why a company can beat earnings and still fall, if guidance suggests softness ahead. And why a company can post modest numbers and still rise, if guidance signals durable momentum. Results tell you where a company has been, guidance tells you where it believes it's going, and in today's environment, that belief, and the confidence behind it, is often what matters most.